When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, the stock market. Also, we'll be taking listener questions, giving you some answers, and planning for long-term care. My name's Jeff Shea. As always, I'm just here to ask the questions, but you know the words of wisdom and solid advice. They come from the other Jeff in this radio program. It's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, happy Easter. How are you doing this weekend?
Doing great. How are you doing?
I'm doing great, thank you. Looking forward to another great show. Hope everybody is having a great Easter weekend. And I don't know, I've read the Bible. I'm sure that you have, Jeff. I can't find any place in that Bible that talks about bunny rabbits and Easter eggs and chocolate and stuff like that. I don't know. I think I'm missing a little something there. I don't know.
I think it just has to do with the warm, fuzzy feeling we're supposed to have around this time of year, the warm and fuzzy. I guess to make it not so, for those that aren't devoted Christians, that might be something else to make them feel warm and fuzzy, but hopefully everybody feels great this weekend.
Well, the bunny rabbit, I think, is a sign of fertility. Certainly, if you've ever had a couple of bunny rabbits, you know how fertile they can be. But anyway, let's not get too deep into it. Let's celebrate Easter for what it is, which is a very important holiday. And we certainly hope that you have a great one. Jeff, let's talk about what's going on in the market, in the news. The S&P 500 has found itself in somewhat of a situation called a death cross. This is the first time this has happened in 3 years. So what exactly is a death cross? And should we be worried about that?
The death cross is when like a 200-day and a 50-day moving average crosses. And what that means is if you look at the trend of the stock market, if the trend is going up, the 50-day trend would be closer to the current price than the 200-day trend. It would trail on the way up. And what happens is technical traders and people that look at trading see that, as long as the stock market holds above these two levels, they create what's called support. And so if the market starts tailing off a little bit and goes down below the 50-day moving average, which, is the last 50 days average, is going to be lower if the market's trending up or even if it goes sideways. If it goes sideways or down for a while, that 50-day moving average is going to start rolling over and start going down as well. But if the market goes down faster, you're going to end up running into this 50-day moving average. The 200-day moving average is going to continue to grow because there's 200 days of pricing that's fit on that line. So you have to kind of visualize this. But the bottom line is typically the 200-day in an up market is going to be lower. And when the 50-day goes down and crosses over that two line, let me back up a little bit. They call that a support line. If you're above the 50-day and the 200-day moving average, typically in a little correction, you might go below the 50-day average. As soon as you go down to the 200-day moving average, for some reason, computers, algorithms, traders see that as a support level of this is the lowest it's going to go. Well, we've been under that 50-day moving average for quite a while now. And every time the market over the last 6 months or so has tried to go up, actually it's been for about a year, every time the market tries to go up, it keeps bumping into the bottom of that 50-day moving average and going down towards the 200-day. Well, if it goes below the 200-day, and the 200-day is actually higher than the 50-day, and the 50-day goes down, it crosses. And so when that crosses, they call that a death cross because the 50-day moving average now is the resistance line for how far the market can go up. And that's been what's really kept the market from going up more than it has. Even on the way from about 5,500 on the S&P up to 6,000, the market kept on trying to get back up after a kind of a hit we took last August. If you look at a chart, we kept trying to bounce back and the market kept on getting up to that 50-day moving average and just kind of stopping right there and coming back down. We started seeing a lot more softening in the market since the first of the year, especially these last couple of months, where now we're far away from that 50-day moving average. And now we're heading towards the 200-day. So just a matter of a few weeks ago or less than a couple of weeks, these averages started getting really, really close. And they just finally touched just in the last couple of days, this last week, the market has been falling and staying under that 50-day moving average, and it actually got under the 200-day, which has been another barrier of, oh my gosh, it broke down another line of support. So it actually went through the 20-day, 50-day, 100-day, and the 200-day moving average just since February. And that means it kind of blew through support on the downside, which means most traders and hedge fund managers are going like, oh, this has looked like a very weak market because we're not getting the support on these average graph lines that we normally get. Well, when the two that I mentioned, the 50-day and the 200-day cross, now we've got an issue where we're underneath all those lines. We have to break through all those lines on the upside in order to get back to a point where the market's actually supported. In other words, now we have resistance underneath all those different moving averages. So we're getting a lot of signs that this rally is probably going to have a tough time moving forward. We've had several signs in the fact that there's a multi-bubble situation happening that always ends in recession, multiple ways that end in recession. And I've been talking about that for a couple of years. We've got economic indicators down. We've got more private households owning equities than normally do, just because there gets this sense of euphoria when institutions don't want to own all the securities the private investor does. And that's typically not what we call the smart money or the insider money. And the insiders and the hedge funds and the big money guys like Buffett have been selling into this for a long time. So it's basically coming to fruition what, has been being set up for the last few months and actually a couple of years. So is this death cross serious? Well, historically, yes, it is. But what's more serious is as soon as the market stays underneath all those moving averages and all the moving averages are above where the market is, those lines become lines of resistance. And there are algorithms and trading patterns and traders that use them for their signals as to when to buy and sell, because historically they've made a lot of money doing that, or they've been able to save themselves from over risking or staying in the market too long, et cetera. So professional traders use this stuff all the time. Mostly the non-professional trader typically just listens to the TV and the blowhards on TV in the morning that say, oh, it's time to buy. Oh, buy the dip. And they just go and do whatever they say and think that that's, a bona fide stock dip, when in fact, it's really just cheerleading for the benefit of Wall Street and more of the insider, the smart money firms that are trying to probably unload. I mean, we've known that this market is overvalued for a long time. The funny thing is the same guys that are saying, oh, the market's way overvalued, we should see a 30% correction before we're willing to buy in. And we've been hearing this from well-noted hedge fund guys and big money managers for the last few weeks. But these were the same guys that 6 months ago said, yeah, well, based on the forward-looking price earnings ratios, we're still fair valued and we still think this market has a long way to go up. Well, they were saying that so they could keep selling their stocks at a high price to the unaware investor that was buying them at a higher and higher price, thinking that there's no stopping the upside. When in fact, we've had no earnings the last couple of years to speak of, yet the market's been growing like crazy. So now it's incumbent on these traders, the Wall Street guys, to say, oh, look, and by the way, the charts now support it. So if it does go down and the traders do make this self-fulfilling prophecy happen, that there is resistance in the market, now they're saying, oh, don't buy the market until it's below 4,000. Maybe 3,800 is a fair entry point. Some people I've even heard quotes of 2,800 to 29 is where the bottoming of the market is going to happen on the S&P. These are all opinions. I don't know who's going to be right. Well, that all remains to be seen. I do think there's probably some more downside pressure, obviously, because things like the death cross kind of remind us that the market's weaker than it has been in a long time. We've been in stagflation for a long time. Before Trump got in office, this isn't just a Doge issue, or it's not just a tariffs issue. It's an economic issue that hasn't really been reflected in the market. And typically the market and the economy are two different things. Eventually, the economy in the face of a recession, when people need to run and get their money out of the market, does cause weakness in the market and does cause bear markets. Bear markets and recession very often go hand in hand. So we'll see how this all plays out. I don't know what the bottom is, but I still think the market is overvalued. And when the smart people are finally admitting it, I think their hope is that they'll cause enough fear that people will sell so that they want to rebuy the stuff they've sold over the last few months and last couple of years. They want to buy it cheaper. So man, if they can talk the market into believing that 30% lower than today is a fair market value, and everybody buys into that and starts selling, and then they get to buy it back. By that time, it's going to be in what we call the capitulation stage, where everybody's scared. They're running like Chicken Little saying the sky's falling. There's no way I can't get in the market. I've lost everything. And wow. But the market makers and the smart money said, great, thank you for letting us sell expensive, sell high in the last few months or few years. Now we're going to buy cheap. And typically it's the Main Street investor that loses. But, if the Main Street investor knows a little bit about market trends, market tendencies, resistance and support lines, and all these graphs and all this technical stuff that we're now talking about, which is probably over the head, honestly, and I'm not by any means demeaning the listener, but they don't do this for a living. many times the only thing that they have to go on is either have a good advisor that does pay attention to this stuff or try to make sense of it by studying themselves or becoming a little more savvy in technical trading and finding out what makes the market tick and what trends are and when trends change and when it's a good buying opportunity, when it isn't a buying opportunity. But we've said this before, I think even in our last week's show, how the average investor that has an advisor makes more money over time than the person that doesn't have an advisor. And I think a lot of that is because they have a little bit of insight as to what's happening behind the curtain. And the wizard behind the curtains, spinning the wheels and making things move. And we really don't know what he's doing back there. Wall Street does because they are the wizard, right? And they're typically playing the game so they can win. I think in their mind, they just say over the long haul market, it'll be fine. You'll be fine. Everybody goes through a little bit of pain. Cycles happen and oh, well, so what? But in reality, cycles do happen. In reality, we do get overvalued. In reality, we always do come back to fair value. Does it hurt the average investor? Yeah, because they're uninformed. They don't know how to mitigate the risk. They don't know how to take the profits off the table. They don't know how to do shorting the market and make money when it's going down and a lot of things that the sophisticated investors and the insiders do. But shoot, they don't want us to know that because then their game doesn't work. So again, it's unfortunate that Wall Street and the institutions typically have to play opposite us. If you don't believe it, watch the movie The Big Short that talked about the '08 crash and how Wall Street was recommending one thing and doing exactly the opposite behind closed doors and making billions of dollars and putting their enemies out of business by screwing them over on bad information and options and hedging and derivatives and all kinds of stuff. They were just in the game to win, and it's a very self-centered world, unfortunately. If we get on the ride at the right time, we can make a lot of money too. And if we get off the boat at the right time, we can preserve those assets and we can just kind of paddle around in safe waters while we're waiting for things to shake out, which is what we've been doing for the last couple of years. By and large, we do have some clients that are still in the market with some of their money that they like to have some exposure. And the last couple of years, they've done okay. But, if you can't afford to lose that money, you shouldn't be in the market. And if you're using it for income, that money should not be in the market either. We should be in those things that keep the principal safe, that guarantee a nice, slow and steady return. Sometimes we use market-related investments that go up with the market, but never down with the market and lock in gains along the way. Those are the ways that we preserve what Wall Street does for us on a way that we can be more in charge rather than what Wall Street gives us, the Wall Street takes away. What Wall Street gives us, we can preserve and not have taken away if we do it right. So yeah, the death cross is definitely something that I think an investor that's taking a lot of risk ought to be concerned about. And typically in history, those death crosses are very meaningful. They're not just a bunch of hype. Sure, it makes news, but why does it make news? It's because there's been some very bad times when death crosses have happened before. And they've happened for a very short time, and they've bounced back with the massive QE. I think we had a death cross in 2020 during COVID, I believe that 1 month, but that was short-lived because they just printed trillions of dollars and threw it into the market and fixed it. I don't think we're going to be in that boat anymore. We've got so much debt. The whole idea of Trump getting into office was that we have a businessman there that doesn't like to increase the debt, but wants to fix it by normal business means, by creating economic growth and creating those things that would pay down the debt rather than just throw money at it to save the market. So I don't know what'll happen on the QE, the quantitative easing side of things. I think the QE that we'll get is maybe kind of forcing the Fed or forcing a lowering of interest rates. However, if bonds sell off because people need to raise money, guess what? If bonds sell off, the bond prices go down, it really makes interest rates go up. You can say we're going to lower interest rates on the Fed level, or Trump can say we're going to lower interest rates, but does it really lower it? It really depends on the bond price. And we've seen that just recently with bonds selling off, making interest rates go up, even though the market's been selling off too. They used to work opposite way back in the day. They used to kind of work hand in hand, kind of bonds were a hedge against the market. But that doesn't seem to be the case now. They sell off together and they grow together very often. So anyway, a lot of things to think about. Yes, death cross is real. Yes, it has a history. You can look at the history and basically we can make decisions and decide how much risk we want to take based on that history and also increase our level of caution based on that same history.
Talking with Jeff Logan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about the death cross. We've been talking about the markets and in general, how you should react to what the media is telling us is going on in the markets. And I think really the general consensus is don't panic. If you'd like to look into it deeper, maybe talk with Jeff in person and get his interpretation as to how these would affect you and your retirement journey, give us a call here at Premier Retirement, 520-780-9059. That's 520-780-9059. You can make that call right now if you want. Leave your name, telephone number. Shelly will call you back and set up a time for you to come in and sit down and talk with Jeff. Now, there's no cost to this, absolutely no obligation, just a casual conversation between you and Jeff to get some answers about your portfolio and how the market will affect that and anything else you really want to talk about, too. We can talk about it all here at Premier Retirement. 520-780-9059. Call this weekend. Set up a consultation with Jeff. If you don't have a plan, get a plan. If you do have a plan someplace else, it probably would be a good idea to get a second set of eyes on that, and we recommend that Jeff take a look at that for you. 520-780-9059. You can also find out more about us online at premret.com. It's PREMRET.com. Jeff, you talked about bonds here in the first part of the program. The bond market has certainly had a sell-off, and that has investors on edge. The bond market is sort of a harbinger of economic anxiety. When the bond market speaks, the stock market reacts. Is the bond market sell-off, in your opinion, more worrisome than the stock market?
Well, they go hand in hand, as I mentioned in my last comment. Yeah, a bond sell-off typically means prices are going to go down because there's more sellers than buyers. Typically, it makes prices go down. Same with stock. Same with everything. More sellers than buying on real estate makes prices go down. More buyers and less sellers mean, a seller's market and prices go up. So with bonds, a lot of people, because of the recent stock sell-off, I think we're selling bonds just to raise money because they needed money for stuff, and maybe they were trying to cover short positions, or maybe needed extra money or needed to solve some sort of a problem and sold off. The other thing is I wouldn't be surprised if some of that was foreign countries trying to just mess with us, kind of a retaliation for the tariff situation by selling a lot of the bonds. Now, we know that government bonds are not just held by Americans, they are held by the world as kind of a preferred currency, really. A lot of the countries own bonds as part of their own portfolio, and U.S. government debt is very, very high quality paper. So if they wanted to tick us off, they could just keep selling bonds, drive the price down, which I think is in part what happened. And that would make the interest rates go up. If interest rates go up, you can't borrow. Shoot, banks aren't loaning money anyway, but who want to borrow at higher interest rates? Who'd want to borrow an overpriced house with 7 or 8% loan when we could have got that house for less 3 years ago and with 2% mortgage? People are scared to even use debt, right? So interest rates go up. The other thing is when interest rates go up, it hurts stocks because most companies do service debt. They do borrow money. Tech companies are notorious for needing low interest rates to handle their cash flow in their businesses. So that's going to filter in and kind of hurt our market. So I think the bond sell-off exacerbated the market fall last week, even though I do think it's overvalued and has to come down to some equilibrium status sometime. But the sell-off we got a couple of weeks ago, just a couple of days, falling 10% or more in just a matter of, just minutes of each trading day, it seemed, was not an orderly sell-off. It was exacerbated by some big players in the back room somewhere, doing big deals, big sales of bonds, big block trades on stocks and driving the market down. And then you get people that are a little bit scared. Well, and then you get a few days later, you get this idea that the tariffs might be put on hold. And so we get this fake bounce on Tuesday a couple weeks ago. And I think the market is like, oh, wow, all we have to do is put them on hold and then everything will be hunky dory. So the very next day, I don't know who was behind all this. I think there was probably some shenanigans from the standpoint of certain people knew this was coming. And because of the trial run on Tuesday, knew the market was going to just surge based on the idea that tariffs were going to be put on hold. Bonds, even for a second, stabilized. The market went crazy. People who bought options at unprecedented levels on the upside of the market. And by the way, because the momentum was downward, I had options on the other way. But I'm dumb money. I mean, I'm not sitting in the White House here and when Trump's going to make this announcement, I don't sit on the board of Schwab and know when I can buy a ton of options from Chase or one of my competitors and screw them over to the tune of billions of dollars when the market surges 8% the next day or whatever. There was a lot of interesting manipulation, and all it had to do was get started. And what happened is people who sell short basically sell high in hopes that they can buy lower later. And everybody wants their profits when the market's going down, short sellers. And this is maybe an interesting concept, a new concept. Now, a lot of people and day traders will short the markets, hedge fund managers and stuff can short the markets, but they don't let you do it in your 401k. Most people don't even know how to do it. And most people don't even have permission to do it with their broker dealers and their online accounts that they use on a day-to-day basis. But short sellers were in deep and were very profitable when the market's going down. And when the market starts shooting back up, they have to buy their stock back. So all these extra buys made the market recovery even more huge than it would have otherwise been. It might have only gone up a couple of percent absent short sellers, but because there was such amount of people that had to cover their short positions, that the market just surged at crazy levels. Now, once that surge was over, most people sold their options, they cashed them in, made a bunch of profit, and then the market got soft again. And it's kind of been bouncing pretty much up and down since then, with some good days and some bad days and somewhere in between. We haven't seen the capitulation stage at this point, but we still have seen weakness in the market. We've seen volume at fractions of what it was during the big sell-off and the big run-up right before that. So there hasn't really been a lot of direction in the market. I think the bias is still down. The economy is still not recovered. The tariff situation has not been resolved. It's just the can's been kicked down the road, but that doesn't mean we're going to have 2 months of bull market, then another crash. And if you think that's the case, then maybe you become a day trader and start trying to time the market a little bit. That's really hard to do, by the way. There's certain times we can play the momentum or we just play the odds. And that's why we've been largely avoiding the market, because the odds are not in our favor of making money. Even though it goes up, the odds are more in favor of a correction or more equilibrium. Now, the odds will definitely be in our favor when the market gets down. I mean, if we see numbers in the S&P below 4,000, shoot, I'd say that's a great time to buy. You're getting it at prices that we haven't seen in a couple of years. You're buying back in where we should have continued to have the market correction back in the 2022 era. And it came back pretty nice since then. But I think the market was a lot more fairly valued then than it is now, because we haven't had any growth to support it. Eventually, the Trump policies, I believe, will support growth. The increase in manufacturing here in America, the increase in good jobs, high-paying jobs. There's a lot of government workers that haven't really been doing a lot that are getting laid off. Guess what? We've got a great workforce that many of them probably have a lot of admin skills and other skills that can be put to use in some of this greater production that we're going to bring home to America. So I think we're poised to launch from where we end up settling, which shouldn't be in the too distant future. I've seen a lot of estimates by people I believe are smart and very highly respected economists that unfortunately you can't get their stuff on the news because it's kind of counterproductive to the euphoria that the market wants to create or the sensationalism that sometimes they want to promote. Most people think that whatever recession we do have is going to start within the next quarter or so, and then it will probably end sometime in early to mid 2026. And we'll probably see better times ahead. That doesn't mean we can't make money between now and then. It doesn't mean we should ride the market all the way down during that time if we are using that money to live on. If we're 20 or 30 or 40 and you have 20 years before you need it, just keep on dollar cost averaging. It's a whole different game for you. But again, this is the Premier Retirement Show. So if you're on the verge of retirement, I think the writing's on the wall that this is probably not time to swing for the fences and try to hit some home runs in the market right now. And it hasn't been for some time, but we'll see. Those days will be back. In a retirement that lasts decades, we'll have plenty of good years. We don't have to be in it all the time. That's what Wall Street says, because they can play their rules against our hold and hope method that everything's going to be hunky-dory long-term. And I think that it always plays out that way. But what is long-term to somebody who's retired and needs a paycheck every month? Well, that's not long-term money. That's short-term money. What's long-term to somebody who's 20 years old, just starting out a 401k and has 40 years between retirement? Set it and forget it. Don't even look at it. You know, it's a whole different story. So again, depending on what phase in life you're at, kind of probably dictates how interested you have to be in the news of the day, how worried you have to be about the death cross, how worried you have to be of whether or not bonds are going up or down. And to finish that bond discussion, bonds are a big player in the Wall Street picture, even though people typically, other than Jeff Gundlach, huge bond trader, and some of these other guys, PIMCO, and some of these big bond funds play in bonds, they make their money that way. But most traders and most investors don't sit in bonds because they think they're going to make a ton of money on it. But nevertheless, it's a big deal when it comes to credit, pricing, the cost of doing business, and many businesses' well-being is derived from what the bond market does. So it is important to keep in mind.
We're talking with Jeff Logan on Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about the markets, the death cross. If you're not having these sort of in-depth conversations with your current financial advisor, you want another look at your portfolio, you want a plan, well, we're offering it to you right now. No cost, no obligation from Jeff here at Premier Retirement. It's just a chance for you to sit down with Jeff, talk about what your plan currently is. If you don't have a plan, for Jeff to design a plan for you, or as I said, put a second set of eyes on the plan that you have. Our telephone number to get that with no cost, no obligation, 520-780-9059, 520-780-9059. All you've got to do is leave your name, telephone number. Shelley will call you back and set up an appointment for you with Jeff. No cost, no obligation, certainly, and no judgment. 520-780-9059. You can also find out more about our firm online at premret.com, premret.com. Jeff, time for a break. When we come back here on Premier Retirement, we'll answer listener questions and more when our program continues. Right here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for making us part of your Easter weekend. You're listening to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We have had a very robust conversation this morning about the death cross and the markets in general. If you missed that, you'd like to hear that, go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a prosperous retirement. You can also find that podcast by simply Googling Premier Retirement Jeff Hogan. It is that simple. If you'd like to get in and talk to Jeff about your individual situation, your plan, lack of a plan, or maybe have a second set of eyes on the plan that you have, 520-780-9059 is our telephone number. No cost, no obligation whatsoever. 520-780-9059. Make that call this weekend. Okay, Jeff, time for weekly listener questions. We'll start with Jack listening to us in Tucson. And Jack says, I need advice and I want to avoid political arguments. I think the current administration's tariffs will eventually lead to a massive recession, if not worse, over the coming year. About 4 months ago, I moved the bulk of my retirement funds into international stocks and blue chip funds. So far, I've made a 5% positive return this calendar year. I've invested most of it in dividend-paying stocks and gold. That has been roughly flat this year. With retirement only about 5 years off, what do you recommend to achieve a roughly 3% more positive return at this point? Some companies may be bringing money back to the U.S., which will stabilize the dollar for a bit, but I'm worried about the long term. What's your opinion?
Well, as far as the dollar, I think a lot of people give way too much, creditor to the price of the dollar. Other countries manipulate their currency against the dollar all the time, and it hasn't really changed the way Americans spend their money. Certain things have gone up a little bit, certain things have gone down a little bit. As long as you're doing business in America with all this infrastructure that's coming back and all the manufacturing and all the business that Trump's trying to bring back to our land, the US of A, I don't think the dollar or the valuation compared to other currencies is going to make that big of a deal. I think the biggest difference would be what it compares to maybe with China, depending on how tariffs shake out. The thing is China's been manipulating their currency for their own benefit for a long time. It's been hurting our currency or making it look undervalued or look like it's losing value. But is it really? I mean, you're probably still doing okay. I'm doing okay. Most people are doing okay as Americans with the dollar the way it is. So I think people give too much worry or focus and waste too much time thinking about that. As far as making a 3% or more positive return, I mean, shoot, you can lock in that. You can lock in a 5 or 6 positive return on some fixed annuities right now. You can't lock in 3% or more, much more than 2 or 3 years, probably on a CD. You could go short-term government bonds or money markets still paying more than 3, but that's going to be short-lived. If you're just looking at parking your money outside of risk or going what we call risk off, right now, winning by not losing is a good strategy. It's always a good strategy in retirement, winning by not losing. In other words, losing is when you buy high and sell low. Well, you might not have bought high or low, but if you sell lower than you need to because you have to spend that money, use it for living expenses, cough up a bunch of stocks that are down 20% because you have to fix your air conditioner or something like that. Those are ways that you actually lock in losses if there is a good market downturn. And there has been so far. Just from its recent highs, we're down somewhere between 15 and 20% now. Who knows how much more it's going to go? I think a normal correction, a normal cycle certainly hasn't played out yet. If it bounces back, well, great for the market. If it doesn't, well, great for the people that have at least taken the profits that they need off the table and aren't losing them. I've mentioned so many times we have strategy that'll do this where you can keep the money invested, still have access to some of the money for liquid purposes and still not be risk on, as I say, yet still have some good upside when the markets play out and do well. Some of those investments last year did double digits and they're as safe as a CD, and those profits have been kept and they're not losing them year to date. So, there are ways to maybe park your money in something and be happy with a 0% return for now. If you want a 5 or a 10 or better return, when the market gets back in the good graces of the public and of investor. So there's a lot of ways to skin the cat. If you want to make just a fixed 3%, I mean, you can lock that up in different ways, ladder CDs, ladder bonds. That's not a hard thing to achieve right now. But it may be a hard thing to achieve if we get a good recession, we get a good sell-off, interest rates go back down, people kind of regroup and kind of take a step back, quit spending quite so much money and driving prices higher, but sit back and let things kind of normalize again, which usually happens after a recession. A recession means reset. We reset the period and we kind of start over and off to the races again. Americans are quick to forget, not just forget the last time we had a recession, but quick to forget the good times, and then they quick to forget the bad times. We'll go through cycles. We'll have some rocky roads. We always do. That's what life's about. And it's not the last one or the first one that you go through during retirement. It's probably going to be several. They happen on a regular basis every few years. So if you want to sit the market out and you're happy with a 3% return, that certainly is not hard to do. I would probably ladder instruments that could be somewhat liquid over the next few years, just so you can go risk on, get back in the market when it looks like a much more favorable environment to invest and make those double-digit returns again that we used to make. So that's probably my best answer to a short question with a long answer as usual. So I hope that helps.
Jack, thank you so much for listening to us in Tucson. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. 520-780-9059 is our telephone number if you'd like to call and set up an appointment with Jeff. Let's go to the next question, Jeff. It is Gary in Marana. Gary writes, my portfolio took a 20% loss in just a month, and I've noticed that gold is pushing $3,000 per ounce, forecast to go $3,200 or more. Historically, it has been very easy for me to liquidate gold. There's a trusted business advisor at spot price or 95% of it. With the current state of domestic and global affairs, I'm at a loss as to how to keep my economic stability in check. Any suggestions whether I should purchase and or maintain my current shares of stock or buy gold instead? What do you recommend?
Well, I don't know how old you are when you're going to need the money, if you're retired or not. A lot of information not quite there. So let's just say, for the sake of, is gold a good investment? I have plenty of hard stuff I've got 3 different safes and I got a little storage of a little bit in each one of them. But I don't know anybody that actually give me 95% now. I think that used to be the case, but anymore, man, with the gold and the frenzy we're in about it, it's probably a 10% hit. So when you buy the gold, you're going to pay about 10% over spot. And when you sell it, you're going to pay about 10% under if you have any sizable amounts of gold. You'll find that to be the case, at least here in Tucson. I've looked around quite a bit. And if you do have a place, I would love for you to leave a message on where that is. Not that I'm planning on liquidating any. And I have that just kind of like my rainy day. What if I needed money? Better to have it and not need it than need it and not have it, right? I also have a bunch of bullets and firearms. Some people store a load of scotch and whiskey, and that's going to help them get through the hard times. Whatever you have to support it. But I don't like the idea that you lose even 5% going in and coming out of an investment. That's like the old school investments where you bought it and had to hold it forever. $3,200 might be a short-lived price. I think there's still probably some more upside because central banks around the world are buying gold. But I like to buy it with almost zero cost, and you can do that through ETFs, exchange traded funds. GLD is one of them, and it's the ticker for gold. And you get basically spot price. The fees are like 0.1% in an ETF. If you buy it through us and we manage it, we buy those ETFs when the gold is on a run, and we take profits when it looks like gold's getting soft, and it does cycle. We had a couple of cycles where we've been in and out of gold the last few years, a few times over the last year. Right now, we're pretty heavy in gold. Silver looks like it might be making a comeback. It's been kind of forgotten. It'll probably catch up to a better price pretty soon as well. I think precious metals are a hedge, especially when the market gets iffy. However, when there is sell-offs, just like we saw with the market sell-off a couple of weeks ago, gold softened up a little bit too and sold off a tad because when people are scared and running for the doors, they'll liquidate anything they have. I mean, they'll liquidate stuff they have around the house if they need to. They'll liquidate stocks, bonds, gold, whatever, if they need to raise money or if they're in a pinch. So keep in mind, gold can go down in price, but that spot price goes down minus another 5% if you want to carry it in and wait for 9 to 5 hours so you can meet with your guy and hopefully get that gold unloaded. Typically, they have to make a call to Wall Street and get some sort of a firm to guarantee to buy it. And by the time the transaction actually happens, it may or may not be what you thought it was going to be. That's happened to me in the last couple of times that I've bought gold, not in the 3,000 range, but closer to the 2,000 range. But still, in the last year or two, those transactions in the actual bullion have not been quick and easy and worry-free because nobody's just sitting on a safe full of gold they want to sell you. They have to usually broker it. So if you want to get in and out and get the price that you have like any minute during the day, you can do that through the exchange traded funds. We have that as a very big part of our portfolio right now. Anywhere from about 10 to 30% of some of our portfolios are managed with gold stocks and ETFs because they've been holding their own, and it's been keeping us from losing that 20% in the market year to date. It's actually been the buffer that's helped maintain our levels with less losses than many portfolios. So again, it's a great diversification asset class. It's not always good. If you look at what gold's paid over the last 40 years, it hasn't even kept up with the CD and money market. But there are times that it makes sense to hold more gold than it does not to hold it. And I think right now is probably a decent time to consider it. Even at the 32 range, we might still have some more upside. Now, I'm not making a recommendation here. I'm just saying it may be a diversification mode for your portfolio. I'm guessing that if you did have gold, even though your portfolio, the stock and bond portfolio, took a 20% loss, if you had a certain percentage that was in gold, you probably made money that offset some of that loss. Again, that's why we diversify. Some things go up, some things go down. They don't always go up and down together, but hopefully we have enough asset classes to kind of mitigate the risk or make the roller coaster ride a little less scary. Roller coaster rides are always fun, but they don't have to be scary, right?
They're fun when they're fun, but they're scary when they're scary. Okay, Gary, thanks for that question. And Marana will send you out Jeff's book, Retirement, The Road Ahead. Again, you've got a question for us. 520-780-9059 is our telephone number. You can make that call right now. Leave your name, number. Shelley will call you back and set up an appointment to come in and sit down and talk with Jeff about your retirement plan if you don't have one. We'll set one up for you, or at least get that conversation started. If you do have one, Jeff's happy to take a second look at that. Okay, next question. Nicole listening to us in Pima Canyon. Nicole says, I've been married for several years and have a will that leaves everything to my husband. I want to replace it with a will that leaves everything to my adult daughter. Can I change it without his knowledge?
Not in a community property state like Arizona. So if you're here, they would have to disclaim it. In fact, even if you have a will, the spouse has the first right of refusal basically on all your assets, especially if you've been married for several years and live in a community property state, and unless you've owned that property as sole and separate property since you've been married. If that's the case, or if your spouse has disclaimed any right to beneficiary status on that asset, they'd have to sign a disclaimer deed or a disclaimer document that says, I disclaim all my right title interest and future right title and interest to this property, and you can leave it to your adult daughter. So change it without his knowledge, not legally. I know people have tried and probably gotten away with it, but I recommend we just kind of toe the line with the law. And if it is an issue where the situation is, I'm not a marriage counselor, but it seems like there's some issues in the marriage, or maybe this is a his and her marriage where you had money, he had money, maybe you feel it's more beneficial for it to go to your adult daughter, maybe not his kids or not to him. Why is that? Is he going to leave his stuff to somebody else if he passes away, or do you get his stuff? I mean, that would be kind of unfair that you get to give your stuff to somebody else and he doesn't, or you guys just come up with have a heart-to-heart talk and maybe get some sort of counseling that says, what is fair in your situation and this is how we're going to do it. Y'all come to an agreement, sign off on it and move forward. But when you're married, you're not supposed to do stuff without the other one's knowledge, right? So
right.
I don't know. That's my take on it.
Well, this is a tough situation that Nicole is in. She's had a change of mind here, and it seems almost unfair that she can't do necessarily what she wants. But I understand the law that he has to know what's going on here. So, Nicole, we wish you the best of luck with that. Again, you might want to consult with an attorney. We can't tell you exactly what to do, but I think Jeff has a pretty good handle on what you can and cannot do. We appreciate you listening to us in Pima Canyon, and we'll send you out Jeff's book, Retirement, The Road Ahead. You got a question for us? You can get it to us by going to the website, premret.com. Use the contact page there. If we use your question on the air, we'll send you out Jeff's book, Retirement, The Road Ahead. You will also get your question answered on the air. Same number, too, if you'd like your plan, 520-780-9059. Also online at premret.com. Jeff, let's shift gears here and talk about something that you don't have a plan unless you have a plan for this, and that is long-term care. First of all, let's talk about the cost for long-term care, Jeff. A lot of people do not realize how terribly expensive it is and what the possibility is that you will need some sort of long-term care in your life.
Every time I hear it or revisit the odds, it's about a 50-50 chance you're going to go to a nursing home or need some sort of, not just assisted, but some sort of custodial care before you pass. So that's about 50% or better. So, and the average stay in a nursing home is actually somewhere around 3 years. However, I believe it's 80 or 90% of the people don't make it a year. And that's because most people go there just as the final situation. And some people that are younger maybe become invalid or crippled, end up living there for several years to kind of skew the averages. But bottom line is it's more costly than typically renting your house, right? If you have somebody come into your home and take care of you, it's going to be $5,000 a month. And that's probably not if they live there full time. That's just coming for meals and dressing and in and out throughout the day. If you move to an assisted living facility, it's a little more convenient for them because one caregiver can take care of 6 or 8 people, and that might still cost you $4,000 to $6,000 a month. Now, that's in today's dollars. So consider, in the future, it'll probably be even more than that. Want to go to a nursing home? Well, depends if you want a semi-private or private room. Somewhere between $6,000 and $7,000, probably on the very low end, and $10,000 to $12,000 on the higher ends is what it takes right now. Multiply that by, somewhere between 1 and possibly 3 years. Dementia is the one that I think keeps people a long time. Just because you're mentally deficient doesn't mean your physical abilities are diminishing at the same pace. So that may require more of a lockdown scenario, which requires even more care, more security, and more money. So it's very expensive. If you look at the overall population of retirees, they say that healthcare is going to be the biggest cost in retirement. For our clients, it's definitely taxes, because we deal with people that actually have some retirement assets, and typically, 401ks and IRAs when they come out are taxable, and people that have means end up paying a lot more in taxes. However, it could be a few $100,000 or more, the average healthcare cost for a senior these days, somebody who's retired. How do you pay for that? I mean, there's a lot of different situations. Some people have assets that they can use, like equity in a home. Some people buy a pay-as-you-go insurance policy. Unfortunately, those can go up and the premiums be raised over and over again, or the benefits could be cut. Many companies know that if they deny claims, they have a chance on not paying a claim. And some companies have a policy to keep denying claims until they can't deny them anymore. And that makes it hard to collect payments sometimes. There are options where people buy retirement annuities that, let's say the annuity grows by 3 or 4%. If you go to a long-term care, maybe they'll double the amount you made as an extra long-term care buffer, where you can actually have more assets to use over a shorter period of time than, say, a lifetime income. Because obviously, once you go to the nursing home state, your life expectancy is kind of accelerated to a few years rather than a decade or two. So, and then there's LIRPs, life insurance retirement plans, that can also be used that aren't pay-as-you-go, that can be a nest egg for long-term care funds, and the potential of utilizing those funds before you die as a death benefit, but use it for chronic illness or even long-term care or terminal illness. Then, of course, there's always your house. Some people say the home equity that I've saved is my long-term care plan. I can either reverse mortgage it and stay at home and hire home health care, or I can sell my house and have tons of equity that'll pay my bills in the most posh nursing home that I want to go to. So I probably jumped ahead of your next question, Jeff, is, how do you solve the problem?
Yeah.
There's a lot of costs, but, I think it's definitely, and the reason I rolled right into it, honestly, is because it's part of every plan we make, is what happens in those final days when I have costs escalate. When people retire in the go-go years, and they're very active and doing stuff, traveling, going to grandkids and going to all their games and doing stuff all the time, cost of living could be fairly expensive. And then you go through the slow go years where you're not really doing as much and you're probably not spending as much money. And then you have the no-go years. Those no-go years could be every bit as expensive as the go-goes, when you're spending money doing fun stuff, because you're spending, unfortunately, all your final wind down expenses become healthcare related, and healthcare isn't cheap. So again, you go through this kind of cycle where, in the end, you end up spending more money. It's kind of the go-goes, you spend a lot. The slow goes, you spend a little bit less. And the no-goes, depending on how you've planned, might actually be the most expensive part of your life. And you might have to realize that there's a nest egg you've got to set aside for that.
So if people need long-term care, of course, some people think Medicare will pay for it, but it will not. Medicare pays for things that you'll get better from, and typically what it pays for is around 100 days, so that is not an option. Long-term care insurance policies can be expensive, and, as they go on, when you need them, they get so expensive that you can't afford them anymore. But there are some hybrid possibilities. You touched on the annuities a little bit there. What about a life insurance policy with an LTC rider? I understand that will advance the death benefits accordingly.
Right. And I talk about LIRP, life insurance retirement plan, where instead of waiting to die to collect your death benefit, you actually spend it in a tax-free basis while you are alive. So it actually becomes what I consider true life insurance. The remaining of whatever you don't spend of that death benefit can be used before you die, when you become either terminally ill or chronically ill. And of course, you have to sign up for a LIRP, life insurance retirement plan. We call it a tax-free bank account. Is really, you just stuff it full of a bunch of your money. It grows at a reasonable rate. Probably, if you look at it in any period of history, it'll beat a CD or other safe investments, definitely beat municipal bonds. And you get to use that money tax-free anytime you want to. You actually borrow it from yourself to yourself. And there's never a tax ramification. There's never any taxable event there. You don't get a 1099 for it. It doesn't look like income. You get to use all your savings in a tax-free stealth basis. But whatever's left in that account, you don't have to wait to die to get the rest of it to your heirs. You can actually pretty much use it all up right up to the last day, depending on how well you plan and how lucky you are with the timing of those final expenses and stuff. I want to go backwards and just kind of explain, well, actually, you know what, let me just give you an example, kind of like a case of the week type situation. If, let's say you had a LIRP, a life insurance retirement plan, and let's say you had $1 million in retirement funds and you decided to put 40% of it in this tax-free account. And let's say that account grew by 6% a year. So, in 12 years or so, that $400,000 is now worth $800,000. Let's say, again, you put $400,000 in there, but you actually borrowed the money against your future death benefit, which would be, if you put $400,000 in and it grew to $800,000, you actually have a death benefit of around $1 million. You can spend that whole $1 million based on a $400,000 investment while you live. And let's say you've loaned or you've taken of the $400,000, let's say over the next 15 years, you've taken $40,000 a year out for 15 years. You've taken $600,000 out. But remember, the death benefit is $1 million. Well, you've got $400,000 that you can still tap into if you become terminally ill or if you become chronically ill and need it in lieu of long-term care insurance. So all that money ends up being tax-free. It ends up coming to you basically on your terms rather than on the insurance company's terms. They can't say, oh, you don't qualify or we're going to deny a claim. It's your money. You've set it aside for that purpose. So that's the LIRP version, which is a tax-free version. And some people would rather have, because they don't have a lot of after-tax money to do LIRP, or they don't want to take a big tax hit to move money out of 401ks or IRAs. But you can actually set up an IRA that has some benefits through some really hybrid annuities they're really getting creative with annuities. The old school annuity where you give the insurance company money, and if you die early, you lose the balance of it and you never get it. And you have to live long enough to get all your payments or you won't get your money back. I don't even use those. Those are a thing of the past. That's why annuities have a bad name. You can put money into an annuity, basically a deferred annuity, where you just park the money. It grows at a reasonable rate of return. Let's just say it grows at 5%. So let's just say in simple terms, you put $200,000 in there. It grows at 5%. 14 years later, the thing's worth $400,000. Well, you had $200,000 worth of gains over that 14 years. And then let's say you go to a nursing home. One of the policies I'm just thinking of that we've used frequently for a long-term care backup plan would give you, instead of a $400,000 account balance, it would actually give you a $600,000 account balance. In other words, the gains that you make would actually double so that you have more money, but you get to take that money out over a 7-year payout period if you're chronically ill. And that would cover you for as soon as you can't do 2 activities of daily living. So there's kind of like, just for letting them invest your money, they'll probably make a little bit of money on it. Obviously, they have to be in business, but you make money. They will give you double the credit of your earnings as a payout over 7 years, which would be, a seventh of $60,000 would be roughly $85,000, almost $90,000 a year for 7 years. And let's say you only go to a nursing home for 3 years. You get that $90,000 for 3 years, you pay your bill, and the remaining 4 payments still go to your heirs. So it's not like you lose the money, not like you gave it up. You actually still get the benefit of those extra dollars that have been added to your account. So that's just an example of some of the creativity that insurance companies who have learned how to leverage the interest they make on your money in ways that Wall Street hasn't figured out. Wall Street hates annuity companies. Wall Street hates life insurance companies because they're becoming very competitive as an alternative to just leaving your money in stocks and bonds. I like to do holistic planning, meaning we use all the tools in our bag. We use insurance products because they're insured, because they're safe, because they give tax benefits, because they give long-term care benefits. They cover aspects of your life that a stock and bond portfolio don't. And so split it up into pieces. You have your bucket of stocks and bonds that you can use for your discretionary expenses. And if you do really good, you'd have a really fancy vacation. If you don't do good, well, you weren't planning on spending that money anyway. The other assets can be put into plans that create income streams, that create tax-free income streams, or create a buffer in case you ever have that unfortunate expense where you need long-term care services either in your home or have to go to a facility and get those long-term care services.
Jeff, hate to cut you off, but we're running short of time. You have questions about long-term care, give Jeff a call here at Premier Retirement, 520-780-9059. You can also find out more about us online at primret.com. Jeff, I want to wish everybody a happy Easter. Hope you have a happy Easter. And for Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.